Hello everyone, hello friends, this is Bella. Welcome to the next video of Price Behavior Teaching Series video 12. Today we're going to continue to learn how to deal with the failure of a trading band, and we're going to focus this video on the case, and then you didn't ask questions about the theory, and you saw the last video. So let's look at our first example, which is a 4-hour chart of the US dollar versus the Canadian dollar. The old rule is that when we get a chart, we first look at what is the background of the market in the big cycle. We can see that there is a good downtrend ahead. The first two paragraphs of the second paragraph are relatively easy, and then the second segment has a higher slope than the first segment, and we know that the market is accelerating, and maybe it's going into a state of high water, and then it has a deep pullback. It's important to note that after this deep correction, we saw that the slope of this correction was relatively fast, but it was also a simple correction, and it was a short walk through this deep correction, and then the market did a channel down. Can you see that? Channels, we talk about this down channel, which is usually a bull flag, and then we can also see that at the front band low there is some validation of support, or the price is a little bit of a pause, and this is when he chooses the down break down. The front band point breaks down, the bull flag breaks down the down channel, and the market accelerates. This acceleration may be a high tide movement, and we can also see that the previous two band lows come out with a channel line, and this rush hits the channel line and still doesn't get it as a good support. But the market has fallen too far, and we have to know that, even though it's not the bottom right now, it's not far from the bottom at this point in time to stop blindly shorting and look for a sign of stabilization to participate in the long. So let's look at the micro details. After breaking through the previous band low, this front constant accelerated downhill from the channel here, this front constant accelerated downhill from the channel here. He took a quick. This move has very little overlap between the short trend K line, and then he took another channel, speed and channel. This is also a very common form, rapid and channel. After the price of a deep correction, back test. The breakthrough point is also a starting point of decline acceleration. Then here the short signal is very simple and clear. I talked about these entry in the previous video course, and if you don't get it, you can go back to my earlier lecture, because we're going to focus on intervals in this video, and I just want to mention that this signal is really simple. Let's get rid of all the lines that we just drew, because now we're going to talk about the current state of the market. Now a lot of things are going to look a little bit messy. When we were looking at the background of the big cycle, we knew that there was a three-stage push. And when we hit the channel line, the market had gone too far down and faced a deep pullback or a higher probability of a reversal. At this point, we will look for such educational opportunities to enter the long. What about this uptrend correction, which is also quite sharp and quite high? The decline after this pullback, and if you're experienced in trading, you know that this pullback and then the short breakout to the downside is likely to be a false breakout. And if you're not experienced, like if you're new to trading, so on this breakdown against the previous low, you might think that this is a continuation of the short trend, and then you come in short and you get caught. But the logic of the long order is not what we're going to talk about in this class. We'll talk about the entry pattern in the next video. Let's move on. Here's the test of the previous low. Let's label the level. This test of the previous low is a false breakout. Well, whether it's a signal here or a positive signal here, we know that this downward breakout has failed. And at that point we expect the price to retest the starting point of the decline here and make a wide range. But in fact, what we can see here is that the market has made a false break against this small band point in front of it, and that's when the market goes up and it doesn't work. And that's when the market goes down and it breaks up and it doesn't work either way, and that's when the signal comes up. What we need to know is that the market may have entered a potential trading range, and the upper and lower boundaries of this range are here, and we can also remove this front one. You know, the horizontal line that I'm drawing here is a false break, that we're looking at this down against the previous low, and you should understand that. Here the empty single. In fact, this signal K line is also very simple. Double K line reversal is very standard, is very strong, but cannot do it is not very can. If you listen to the class for a long time, friends should know why not to do, because the signal K line is too long, admission is only too far, although the lower back is more pleasant. Such a long stop loss hardly gives us a profit/loss ratio advantage. With the recent decline, the K line has run to our current point in time, which means that you get this chart just in time to trade. Why do we need to analyze the background of the big cycle so thoroughly first? Because only if you understand the movement of the big cycle you will be able to operate in the small cycle. Is such a trading habit I hope you can develop. It's true that for some of the top traders, they only look at a chart for one period. For example, he looks at a chart for 15 minutes and he can trade. He doesn't have to look at big cycles and small cycles, but if you want to trade at this level, you probably need to do it for 5-10 years. For us in general, we do the simple way. If you look at the big cycle analysis and do the small cycle, is this very simple trading method. Simple and effective, you just do it. It's a drop that if you're not good at reading and you don't understand anything, it's a drop, but if you're good at reading micrographs, you see more than just a drop. What we have here is the same K line with the arrow that we talked about as a signal K line, and we can see that it's a rapid falling motion that's so big that a negative line is placed here that anyone can see, and then it's rapidly connected to what is it rapidly connected to a descending channel, its microscopic channel, and then it's connected to a descending channel, and then it's connected to a descending channel. Alright, so if you're listening and you're learning and you're thinking about the top speed channel, and the top speed is a form of energy depletion, and that energy depletion happens right at the front low, which is what we think is the bottom of a potential range. If you're a novice trader and you see this big negative line and you see this big negative line and you think, wow, shorts are so strong and I'm going to go short because I've got this long negative line. But if you follow me, you know at least two things. The first thing is the speed channel. The speed pattern is that it tends to run out of energy. The second point is that the long K lines at the bottom of the top of the interval are meaningless, like the long yang line here, the long yin line, and it's probably more likely to be the depleted K lines than the strong K lines, and if you follow me and read the diagram you should see these points. We have previously judged that the market is a potential trading range, and now there is a false break to the front band low. Is there our entry signal, K line, to participate in the long? As we said before, our main entry number K line is single K line reversal, double K line reversal, and second break. None of these three signals are present here, but there is an entry signal, but it is very difficult to capture. It requires a strong sense of market power and reading ability, which is very difficult for the West to understand, let alone master. But I can talk a little bit about it, and if you understand it, listen to it, and if you don't understand it. So if we look at the long short K line and we say it's the high tide of the short and the K line is running out of energy, what about this little K line that comes after it? How to understand this little K line? First, there is the orgasm movement, and then there is the pause of the little K line. The pause of the little K line is actually a confirmation of the high tide. How to understand is the price, its rapid movement suddenly stops here. It could be this long K line, or it could be connected to a small short K line, which is a kind of confirmation that the high tide is running out of energy, but it's hard to get a handle on that, and I won't say much more about that. But look at the back K line. This positive line looks stronger, it has fewer upper lines, and it's closing above the high point of the previous K line. If you are an aggressive trader at this point, you can already participate in the long. Of course, if you are a more experienced trader, when the long short K line comes out, you will already be long, but its stop loss will be further. If we look at the back of the market, the red arrow is our last signal, the K line. We can see that the market doesn't give us a second chance to break out and go long, it just goes up. If you're a conservative trader and you like to get into the market on a second chance, then sometimes it just doesn't give you that chance. And if we look at the rise and we look at the slope, we see that the slope of this line segment is also very high, and it indicates that the rise is moving too fast, and this rapid movement may be a manifestation of the high tide. If you're a novice trader who doesn't know technical analysis and can't read charts, and he sees this rally and he thinks, more good strength, I'm going to get involved in this, and if you've seen the video and you've been learning, then you should know that we need to look at the market in a more comprehensive and objective way. Rather than you seeing the market rising fast is a bull. See, fall fast is short strong. Does this give us a sign to go short? There's actually a double K line reversal and it's stronger than the norm. But if you were to wait for a second breakout to go short, just like here the market doesn't give you that opportunity, it goes straight down at the first signal. If you take the conservative approach and the market is not going to give you a chance because you're conservative, and you're going to have a situation where if you take the aggressive approach like you're taking the first signal right now, and you're going to have a lower win rate. There is no such thing as a perfect solution in the market. You gain something and you lose something. Trading is a process of making trade-offs. If we look at the recent downward movement, if you are smart, you may have noticed that this downward movement is also too steep and too fast, basically the short K line, and then very few long K line. What does such a rapid movement tend to bring about? A phenomenon that tends to bring about energy depletion and tends to bring about high tide. And such a long shadow, this K line is labeled 1, down, and at the same time the K line of this long line, it also makes a fake break to the front low. One of the things we talk about a lot is that market movements are inertial and they tend to stay where they are, and if a range has been formed, and in fact it's been proven in the previous couple of points, if a range has been formed it tends to stay in that range and it's prone to false breaks. So does that give us a signal to go long K line? Yes, here conservative volunteers also wait for a second breakthrough to enter the long opportunity. Then where is the second breakthrough? Let's take a look and mark it. Now there are some friends who do not know what is the signal K line of our second breakthrough to go long. I do not know how to talk about it again because it has been explained very clearly before. So let's go over here and see how the second break is calculated, and let's go over here, let's look at it again. After the first one it's lower in height. Can you see that? The first high is higher than the previous K line, the high K line appears. The high K line appears and then it goes down again, so the first break may have failed, so now the second high is higher than the previous K line, the high K line, that's the second break we're waiting for, and that's a second entry. So now it has a false break at the bottom of the range and it's a second break and it's a signal to go long, and what do you do at that point? It's pretty easy to just do it, and it's already a pretty standard pattern, it's a pretty simple pattern, it's clear. If you look at the subsequent market action, the red arrow is our second breakout long entry K line. It's very simple behind that, there's not much to say. The important thing is that our entry logic you have to understand. When you have a trading range, where is your target for earnings? When you are in the middle of the range you are flat half and you are holding half. Why do you do that? We explained the logic of order management in the previous video, and if you don't understand that, check out my last video, and if you don't have a good order management strategy when you're in a trading range, you're going to have a hard time doing it. If you look at the recent K line, it's very simple. The single K line reversal is very strong, simple and clear. We see that not only does it make a false break to the top of the range, why isn't the top of the range spent here? Because there's 3 validations here. So we put a claim here that the top, he made a false break. The high K line appears and then it goes down again, so the first break may have failed, so now the second high is higher than the previous K line, the high K line, that's the second break we're waiting for, and that's a second entry. So now it has a false break at the bottom of the range and it's a second break and it's a signal to go long, and what do you do at that point? It's pretty easy to just do it, and it's already a pretty standard pattern, it's a pretty simple pattern, it's clear. If you look at the subsequent market action, the red arrow is our second breakout long entry K line. It's very simple behind that, there's not much to say. The important thing is that our entry logic you have to understand. When you have a trading range, where is your target for earnings? When you are in the middle of the range you are flat half and you are holding half. Why do you do that? We explained the logic of order management in the previous video, and if you don't understand that, check out my last video, and if you don't have a good order management strategy when you're in a trading range, you're going to have a hard time doing it. If you look at the recent K line, it's very simple. The single K line reversal is very strong, simple and clear. We see that not only does it make a false break to the top of the range, why isn't the top of the range spent here? Because there's 3 validations here. So we put a claim here that the top, he made a false break. And it's also a false break to this uptrend. which is that if you break this up into small periods, so it's an uptrend, that this uptrend, 2 segments later, makes a deep pullback, a pullback to the beginning of the last segment. And what about this pattern we'll talk about in the reverse shift, that pullback followed by a homeoid false breakout? It could be a potential reversal, it could be a bull run out of energy. So this K wire here verifies two configurations. The only thing that you've noticed is that the K line is too long. We can't go straight in. The best thing to do is to put the order in the middle, put the order and then put the stop on the top of the front. Why not put it on the signal K line? Because the 2 points are so close together that if you put it on this signal line, it might not be a good stop and the price might make a false break to your stop and then go down again. If you look at the back of the market, the red arrow is our signal K line. Although it is very strong, it is still rejected by the market. No matter where you place your order on this matching line, you should be stopped, and there is no way, because you can't win 100% of the trade. So what we're going to focus on is we're going to change this horizontal line because it's already broken, and we're going to look at the top band ahead, and we see that even though the band that we thought was broken, stopped, it's still making a false break to the front band. We can see that there is actually an entry signal K line. The first one is a double K line reversal. This shouldn't be called a double K line reversal because it's not very strong, but it's also a reversal pattern, that the first entry we don't do because we say we like to do a second entry, that the second one also has a second break entry short signal. What about the short position that came in here and the price fell quickly? So someone asked the teacher, if I go short here and then there's a fake breakout, can I do more than just lose? It goes up and I go short again, or what? Not at all. Is that a lot of novice traders and even experienced traders are not willing to cut their losses. If you're not willing to cut your losses, you're not going to go very far in this trade. You're going to burn out unless you make money and you stop investing, and that's fine if you make money and you offer to buy a car or a house. Then you're not going to lose money as long as you're in the market. As long as you're not willing to cut your losses, then you're going to burn out and lose money. And you have to remember that stop losses are the norm of trading, and all of our stops are for stop losses. And then the other thing is whether he can do it or not, and I don't recommend it either. Well, most people, let's say we play the stock market or we play the commodity market, let's say we play the spot market, let's do a lot of buying. And one of the mathematical derivatives of the lot buying strategy for you is I buy as much as I go down, and then when it finally starts to rise, where does it rise and how much do I sell? You have to go through strict reasoning and batch building strategy, and you have very strict requirements on your trading discipline. You have to buy it at a low level, you have to sell it at a high level, and when you break your system's final stop loss, you have to get out of the market. So a lot of new people say, well, I'm going to build in batches, and I'm just going to keep buying and not sell. And the day it goes up, most people who do this, or they're going to run out of stock, this is the result of most people. There is no easy money in the education market. You must not be lazy. You must study hard to improve your skills. Here the second break short again, to count it, the last count after the video absolutely will not count, if you do not understand their own to see my previous video has talked about. So let's focus on the lows, because shorting is a breakout of the lows. This low of the K line, it's a break from the previous low of the K line, it's the first breakout, and this one back here is also a break from the same low, so it goes without saying. But what about after this one? The lift of the low is the first break, the first dip, it's over, and we have to count the second time. That's where the lift is also at the site, and it can't be counted. What about this one right here, which is the K line that we just entered, and it's getting lower and lower, and then you're in. And that's the second downward break, and that's how you count it. Very simple. So if you look at what's going on in the market, here's the K line that we just entered. So instead of testing the bottom of the range right after the entrance, the price made a new convergence pattern near the top, deleted it, replaced it, made a new convergence pattern at the top, and then chose to break down and test the bottom of the range. So in fact, when you have this pattern, you have to look at your order and you have to manage it, and I'll talk about that later. We're going to focus on intervals. We look at the price at the bottom of the retest range, and there's still a break that's not false, because the band low has been lowered, but this multiple order is not like the K line, cannot be done. Let's not say the last interval and then change to a new band low. Finally, the interval fell below it. There is no more strength to rebound here. So let's see, let me draw all of these lines, and let's draw them right now. Let's start at the very top and judge from here that it's an interval and it's been running for about 200k lines. Is that not a very long interval running for a very long time? When you say you have the advantage of going to a break in the trading range, or you have the advantage of a fake break, and I believe you've got the case in mind. And then one last thing I want to say is that at the end of the day he was giving us a signal to go long before he broke down, and we saw the down channel go fast, and then this short guy ran out of momentum. It's at the bottom of the range, and then it must have given us an entry to the K line, and then this one was stopped. But let's remember how many trades we made in this whole range and whether we made money or lost money, and let's not talk about these three. You might not be able to do it if you don't have the ability to do it, so let's just say it's a simple trade and the next multiple order is very easy. It's a big gain and the way is very easy. As I said just now, I don't understand it, so let's take a look at that one short order, and we cut that one short order and it's a big gain. And what about the multiple order loss? So let's take a final look at how much we've gained and how much we've lost, and I don't think you even need to count it because you can just look at it and see that we've gained a lot more than our stop loss, and then in this interval you've made a lot of money. Let's just do two more simple examples of the 4-hour chart of the pound versus the dollar. Some of the beginners say, I can't judge the potential trading range. But it's true that to judge this potential opportunity, you need experience reading charts and trading. But you can wait until a band has been clearly formed to do. For example, there is a verification of the band of 2 points up and 2 points down, and then you can participate in it without any problems. In our case, we can first look at the movement he has done before, and we can see 3 upward pushes. 1, 2, 3 pushes are called wedges in our system. Maybe it's not drawn standard, but it's treated first. So for the wedge we tend to think that he's going to test this band starting point. It's a little messy to get rid of the line. We tend to think that he's going to test this point, but what does the market actually do? We found that the price made a signal K line on the third push across star with a long shadow, but its decline gained support at the previous band low without testing lower points. So how are you going to manage the order, or what is your graph reading logic going to be? A transition, that is the market what it's supposed to be doing, it's not doing the interval, and that's when you're going to change your perspective and you're not going to be thinking he's going to test this point. You're definitely in a new state, you're going to give up your original analysis. Where else does this kind of case come up? Let's say an up, let's say up channel, down channel, up channel are all bear flags, the down channel is a bull flag. So let's say there's a downtrend right now, and a downtrend is doing well, and it's making an up channel adjustment, because the up channel we tend to think of it as a bear flag on the way down, but when it's supposed to go downhill it doesn't go downhill and it does the horizontal interval, and then at this point you're reanalyzing, and at this point it's this bear flag, and the probability of the channel going downhill isn't necessarily that high anymore, and it's making a new market state, and you're going to analyze it in terms of this new market state. If we look at the price that has gained support from the previous band point, and then it has a horizontal pre-resistance that it has tested several times at the top, then the price is already in the range. We don't look at the back of the K line, let's get rid of the back of the K line, and the price is already in the range here, which is that it's already formed. Let's say you can't tell where the range is, and you haven't traded before, and now the range is formed and you're looking for an entry. Let's look at this line, K line, what is it? It's a false break to the upside, and we're saying that ranges are prone to false breaks, because the market has an inertial tendency to maintain its current state of motion. So if you take this horizontal line as the upper boundary of the range, you might think that the range has been broken, but we can't ignore that there's another high in the range. Right? If you this band high point as the basis, then this line K line is a very obvious false break K line. It is a single K line reversal. If the price falls below this line to line this need, if the price behind the break this signal K line, this single K line reversal entry is established. If you look at what's going on in the market, the red arrow is the single K line that we just had the inverse K line after the price breaks the entry. It's a very simple drop, there's nothing to say. The point is the entry logic. The entry logic must be understood that this two-stage drop, what do you find? The eagle-eyed friend, the smart friend, found this K line, which is very large, compared to the long short K line. What could it be? It could be a sign of the airdrop running out of momentum. Those of you who have been in this class for a long time should have noticed that this long short trend K line, he hits the bottom of the range and then this K line in the back stops. When do we enter, and why is this unit so simple? Let's see what it is over here. It's the second break at the bottom. The long K line is pretty standard. So let's just recap a little bit, and just to be brief, first of all, the 2 points above the 2 points below the interval has been formed, but at the beginning the upper boundary at the beginning is something I've deleted. Don't forget the upper boundary at the beginning is something like this, and then, because the market conditions have changed, we've drawn a new upper boundary. The lower boundary has been established. A two-stage decline. The long short K line has hit the bottom and maybe the short has run out of momentum at the same time. There is a second break into the long signal K line. This trading logic has three very simple. I'll look at the subsequent market trend. The red arrow here is the second time we broke the long K line that we just entered and very simply hit the first stop, which is the middle of the range, and we didn't test the top of the range again, but I don't care because we were already half flat in the middle of the range and maybe half flat in the subsequent swings. We'll talk about the order management part later. But are there any new trading opportunities at this point in time? If you want to talk about it, there are some new trading opportunities that we had at the beginning when the boundary was broken and a new boundary was established, and that's what these 2 points confirmed. But what we found was that it actually validated a new upper bound of the interval several times over. And a smaller interval within a larger interval was a pattern within a pattern, and the other pattern was fairly common in trading. In this new intercell, there's a 20-odd short signal K line, but the signal K line, some people will come in and some people won't do it. So why not do it? Because it's the background of this big interval, and this is in the middle of the interval. We're talking about the trend probability of 50 to 50 up and down the middle of the interval, and there's not a good advantage. Although in the small form it does seem to be an intercell top, and that's when it becomes controversial that you have a market that is not defined and some people are not going to participate and some people are going to participate depending on your trading style. What we can do at this point is draw a new lower boundary of the interval is the support level down. And in this interval pattern you will often adjust your horizontal line, which is very normal, because the market rarely gives you a perfect interval. It gives you an upper and lower boundary moving in the middle all the time, which is very rare, and you will often adjust your horizontal line. Well, in this new zone, are there any opportunities for us to enter? Well, if you look at it, there's not a very good signal. The K line, for example, if you go long you don't get a signal to go long. The K line just goes up and there's no entry. What about the back end, where the market has this horizontal overlap of K lines with lots of shading, and this is a little trading band? Then the market enters a new level of uncertainty, and we probably don't want to participate in it anymore. But here we do have a long signal. We see a sophomore or a double or long signal that the market has rejected. Finally, a big negative line breaks out of our trading range. If you think about the movements in this period, and we see that there are some wins and some losses. But in general, there are more gains than losses, and that's enough. You can't guarantee that you're going to make money on every single trade, you just have to guarantee that you're going to make more than you're going to lose, and then you're going to be able to survive in this market over a long period of time. The last case is a 2-hour chart of the dollar versus the Swiss franc, so let's look at the market context. Very clear, very strong bull trend, there's nothing to say. It's a two-stage pullback from here, and here's the big bull trend, two-stage pullback. We tend to think it's going to continue, but what's happening here? We're going to watch. But the two-stage down correction didn't get a continuation of the bullish energy, it got stuck at the previous pullback point, and that's when we have to understand that the trend can go wrong, but that's what we don't do. We just analyze it and we can't get in, and when that happens we know that the trend can go wrong. Is that it has a strong bullish trend and it's subject to a complex correction, so we tend to think it's probably a range first and we can't look at reversals early. Reversal patterns tend to have a low win rate because trends tend to continue is the state of the market. Market movements are inertial, and it's important to keep in mind that such a strong bull trend you don't want to reverse it. You have to think of it as a potential trading range, and some people might think you're an afterthought. This graph gives you say it's a range, but remember my words, I always emphasize the potential range. That's the word I use most when I talk about the range form. Including there is a reversal, and the same is true, it's a potential that the market has this signal that we think it might do, but it doesn't do it. It has to give us the signal K line before we get in. Does that make sense to you? For example, he's at the front band low, and what he's doing is our entry signal, and what the entry signal is, you can see now that we've been talking about this for so long. We've seen the down channel adjust, the channel accelerate down, and this long negative line. What does it represent? And it could be short momentum running out, it could be a high tide performance. The long K line represents kinetic exhaustion, and the small K line confirms this manifestation of kinetic exhaustion, and the subsequent entry is also very simple. Here, you can enter on what you can enter on, whether you enter on a small K line, which is kinetic exhaustion, or you enter on a double break, it doesn't matter, you've got your chance. What's important here is that before we thought it was a potential trading range, it must have been the market that gave us a confirmation of a signal like this, before we knew it was called a range, so there's no second guessing here, and that's the way you read the graph. A lot of times it's a potential, especially reversal pattern. Most reversals are potential reversals, and if the market doesn't confirm to you that, you have to immediately admit that you're wrong and immediately change your trading thinking. Does anyone know in advance what the range of the reversal is? It's very rare that a few geniuses can do it. I think the rest of us just don't think about what the market is telling you and don't try to predict what the market is going to do, and that's not true. Let's mark the second breakout long entry K line, and what about behind that is a short trading opportunity for us? Let's extend this line a little bit, and we realize that it's not really giving us a good signal that the K line is coming in, but we'll talk about that in the future. You have to combine the tools of the trade that you've learned, like a very simple channel line right here. The 3 points of the channel line have been verified and the price is in the top area. Can you register for admission? Of course it's either ours or it's in the course, because we're going to focus on breakouts, and I'm just going to mention whether this short order is something that you should be able to grasp and see, and whether you can do with the trading tools that you know. Let's go back a little bit longer. The price also falls rapidly to the bottom of the range. Remember, I've talked about this over and over again. This rapid movement tends to lead to the depletion of kinetic energy, and at the end of this rapid movement there is a second breakout, the long signal K line. This is the second signal K line, that is our entry K line. There is a difference between the K line and the entry K line. You can distinguish between the signal that the K line is the signal. The entry line is the signal that we actually enter. The K line is not the signal that we enter the K line, but this trade opportunity can actually be illogical, but it's missing something that I personally want to see the most: false breakthrough. There is no way. If you look at what's going on in the back of the market, then the price is going to go straight up, and you see this positive line is this long, and then you have this continuous positive line, and we were saying that this kind of rapid price movement tends to run out of momentum. That's most of the time, so now it's a rare occurrence. So what if it happens? Just admit it. But it didn't really give us an entry. The K bar didn't give us a chance to short the entry, so it went up, and we didn't lose money here, and our multi-order bottom went up pretty quickly. So that's a good example of a failed range break. So there are a couple of things that you should be able to notice when you have a failed range break. The first, market has to start with a potential range, and it has to start with the conditions of the new district. If he's not even a range, then we're not going to have a range break to trade, are we? Second, what is the most desirable market condition that we would like to have is this rapid movement towards the interval boundary, and then a false break of the interval boundary, which is the very desirable market condition that we would like to see when we have a market condition where our trading success is greatly improved. The third is to look for an entry signal, K line, like a second break like this, or a strong single K line reversal, or some other entry condition, and as long as you have those things, then you can trade the range. And the breakout fails, and some people, like I just said, they can't identify the potential range, so you just go for the clear established range. In the next video, we'll talk about how to think about a successful breakout of a trading range, and you'll see that there's actually a lot of similarities between a breakout of a range and a failure of a breakout of a range, because a failure of a breakout of a range is a successful breakout. Thank you for watching. Please consider like, comment, and subscribe. Also don't forget to follow us so you watch the following updates as fast as the video upload. Bye.